Hey everyone! Welcome back to Ponzi Scheme Investments, your go-to channel for all things stock market and investment. Today, we're diving deep into Intel, NASDAQ, INTC, and whether it's really the value trap the market seems to think it is. Here's a quick summary of what we'll cover today. Intel's recent stock decline, their ambitious cost reduction plan, the exciting goals for their 18A technology, and their positioning in the AI market. And stick around until the end because we'll discuss how Intel's strategic partnerships and innovations could actually make it a unique investment opportunity. Trust me, you don't want to miss this. Before we dive in, make sure to hit that subscribe button and turn on notifications so you never miss an update from Ponzi Scheme Investments. All right, let's jump in. First up, Intel had a rough couple of days recently, with their stock plummeting almost 6% on Thursday and then a staggering 20% on Friday. This downturn has led Intel to lower its guidance and roll out a significant cost reduction plan. So, what's the deal with this cost reduction plan? Intel is planning to cut R&D and MG&A modestly in 2024, but by a whopping $2 billion in 2025. They've pointed out that even with 10% fewer employees, they managed to generate $25 billion more in revenue. However, reducing the workforce by 15% can seriously impact employee morale. Intel needs to handle this carefully to keep the ship steady. Next, let's talk about Intel's ambitious goal of achieving 5 nodes in 4 years, focusing heavily on their 18A technology. The company claims a 15% performance per watt increase with this tech, along with a 1.3x chip density. They plan to start volume ramping early next year. However, this ambitious project is not without its challenges, including potential voltage failures similar to those in their 13th and 14th generations. While TSMC argues that their process is competitive with Intel's 3 nanometers, the results will only be clear once the process is fully rolled out. One of Intel's strengths lies in its positioning within the AI industry. They've been building new chips and partnering with dominant consumer companies. Intel's integrated graphics and top-tier chips, some of which are built on TSMC processes, keep them on the cutting edge. This could lead to a cycle where customers upgrade their PCs to keep up with hardware capabilities. Financially, Intel is struggling as it navigates a massive investment cycle. They're breaking even with a 38.7% margin, which is relatively weak in the industry. However, their CFG division shows some strength, boasting $2.5 billion in operating income and contributing more than half of Intel's revenue. The company's DCAI and NEX businesses also show positive operating income. But Intel's Foundry division remains a massive source of spending, with $2.8 billion in operating income losses and a minus 66% margin. They are targeting 2023 profitability with these investments, but only time will tell if they succeed. Intel's path to shareholder returns is currently shaky due to weak guidance and a decrease in revenue. They need substantial capital for their Foundry expenditures, which could delay any strong shareholder returns until the end of the decade. However, Intel's management is making all the right moves. The question remains if these moves are too little, too late. Now, as promised, let's talk about Intel's strategic partnerships and innovations. Intel is treating its Foundry division as an independent company to better compete with TSMC. They're using innovations like Power VIA and leveraging TSMC tiles to protect their CPU design business. They're even stepping into ARM-based CPU manufacturing, diversifying outside their core x86 business. Despite the challenges, Intel's strategic decisions could position them for long-term success and shareholder returns. They're making the right moves, albeit a bit late, but these could pay off significantly by the end of the decade. To wrap it up, Intel is a company in transition, facing intense competition from giants like TSMC and Samsung. However, with their strategic innovations and partnerships, they might just turn things around. So, Is Intel a value trap? We don't think so. Instead, it might be a unique opportunity for those willing to hold out for long-term gains. Thanks for watching. If you enjoyed this video, don't forget to like, comment, and subscribe to Ponzi Scheme Investments. And hit that bell icon to stay updated on all our latest content. Until next time, happy investing!